The VA loan is often touted as the ultimate, no-strings-attached benefit for those who have served, a golden ticket to home ownership with zero down payment and unbeatable rates. And frankly, that's exactly how lenders market it, painting a picture of financial freedom and immediate access to the American dream. But let me tell you right now, that rosy picture hides deep, complex financial traps that can ensnare even the most financially savvy veteran, potentially costing you thousands, limiting your future buying power, and locking you into situations far more restrictive than a conventional mortgage. So before you sign another pre-approval letter or even think about stepping into an open house using your hard-earned VA entitlement, you absolutely must understand the hidden dangers of the VA mortgage trap that lenders rarely, if ever, discuss in detail. Because knowing these 7 crucial pitfalls is the difference between securing a stable future and accidentally shackling yourself to an unnecessary financial burden that follows you for years, making your next move or even your retirement far more complicated than it needs to be. The first and perhaps most insidious trap is what we call the residual income trap. And it's a stumbling block unique to the VA system that catches countless veterans off guard, especially those transitioning from active duty to civilian life or those moving to high cost of living areas, because while conventional lenders focus almost exclusively on your debt-to-income ratio, or DTI, that simple calculation of your monthly debt payments against your gross monthly income, the VA goes a critical step further, demanding proof of adequate residual income, which is the money left over after all major recurring debts, taxes, and the hearty proposed mortgage payment are subtracted from your total income. And this is where the system gets granular and unforgiving, because the VA sets specific minimum residual income thresholds based on where you live, the region of the country, and the size of your family, meaning that even if your DTI is perfectly acceptable, even if you have zero credit card debt and a stellar credit score, if the VA calculator determines that the remaining funds are insufficient to cover basic non-debt living expenses like food, utilities, clothing, and unexpected repairs, your loan application will be denied. Full stop, creating a situation where you are technically financially qualified by every other measure, but fail the VA's unique stress test for daily survival costs. And this trap is particularly cruel because it often targets veterans who are stretching their budget to buy in competitive markets. Believing the zero-down feature means they can afford a higher monthly payment, only to discover that the VA is acting as a protective, albeit frustrating, gatekeeper, ensuring you aren't house rich and cash poor. But the complexity doesn't end there. The VA's residual income calculation uses a very specific, often outdated model for calculating living costs, and if you have a large family, say 4 or 5 dependents, the required residual income skyrockets exponentially, demanding thousands more in leftover income each month than a single borrower would need, and lenders often fail to properly explain this regional difference. What passes easily in a low-cost area like rural Arkansas might be an automatic rejection in a high-cost hub like San Diego or Northern Virginia, leading to frustrating last-minute denials after the veteran has already spent money on inspections and appraisals, believing they were in the clear, and the trap deepens because the calculation is notoriously rigid, not always accounting for specific individual circumstances or unique expense mitigation strategies the veteran might employ, meaning the raw numbers dictate the decision, regardless of your personal budgeting prowess or your commitment to frugality. And this focus on residual income forces a crucial financial reevaluation. Can you truly afford this house, not just the mortgage, but the life that comes with it, after the VA takes its mandatory minimum cut for survival expenses? Because if you scrape by on the residual income requirement, you are setting yourself up for financial fragility the moment an unexpected expense, like a major car repair or a medical bill, hits your budget, and that fragility is precisely what the VA aims to prevent. But in doing so, they create a hurdle that many veterans are simply not prepared to jump over, demonstrating a need for meticulous pre-planning and a realistic assessment of post-mortgage cash flow that goes far beyond the typical lender's DTI check, necessitating a deep dive into the VA's specific residual income tables before ever submitting an offer, ensuring that the financial foundation is solid, not just compliant with the minimum credit standards, but robust enough to sustain a comfortable standard of living for the entire family unit, regardless of the geographic region's cost of living index, thus turning a seemingly generous benefit into a surprisingly strict financial gatekeeper that demands comprehensive budgeting foresight. Moving on, the second massive pitfall is the funding fee reuse trap. A critical element that many veterans overlook, especially those who plan to utilize their VA loan benefit multiple times throughout their career, because while the VA loan famously requires no private mortgage insurance, PMI, which is a huge savings compared to conventional loans with low down payments, it does require a mandatory, non-refundable VA funding fee, which is essentially an administrative charge paid to the VA to offset the cost to taxpayers in case of default. And the trap here isn't the fee itself, which is usually rolled into the total loan amount, but how drastically that fee increases when you use the benefit subsequent times, and how easily you can lose the initial benefit of the low fee structure, because for a first-time user with zero down payment, the fee currently sits at a specific, manageable percentage, but the moment you use the loan a second, third, or fourth time, that fee jumps significantly, often adding thousands, sometimes tens of thousands of dollars to the principal balance, meaning the cost of leveraging the VA loan repeatedly becomes exponentially higher, eroding the very benefit the program is designed to provide. And this elevated fee structure applies even if you fully paid off the first VA loan, because the system recognizes you as a subsequent user, a classification that immediately triggers the higher percentage rate, creating a financial penalty for maximizing the use of the entitlement over time. And the situation becomes even more complicated if you have a prior VA loan that was foreclosed upon or involved a short sale, even if that event happened years ago, because the VA may treat that unfortunate history as a prior use, potentially increasing the funding fee on your next attempt, or worse, severely limiting your available entitlement, which we will discuss shortly. And the only reliable way to avoid the funding fee entirely is through a service-connected disability rating, where veterans with even a minimal percentage of service-connected disability are completely exempt from paying the fee, a massive financial advantage that saves a significant chunk of money. But the trap for many is applying for the loan before their disability rating comes through, or failing to understand that the exemption status must be officially documented and recognized by the VA prior to closing. Because if you close the loan and then receive your disability rating weeks later, the funding fee is generally non-refundable, meaning you missed a critical window to save thousands, simply due to poor timing or misunderstanding the strict procedural requirements. And furthermore, if you choose to make a down payment, the funding fee percentage slightly decreases. But many veterans, focused on the zero down appeal, bypass this opportunity to mitigate the fee, failing to realize that even a small down payment can significantly reduce the overall cost of the loan and the amount of the funding fee paid, making the zero down option, while attractive on the surface, potentially the most expensive path in the long run, especially for repeat users, necessitating careful financial modeling to determine if paying a small percentage upfront is actually the most financially prudent decision when considering the long-term amortization of the funding fee that is rolled into the principal. A fee which, unlike PMI, does not simply disappear once you reach 20% equity, but remains a permanent part of the loan balance, accruing interest over the life of the mortgage, thus transforming the seemingly benign funding fee into a continuous compounding cost that exponentially increases the total amount repaid over 30 years, demanding that veterans meticulously weigh the immediate convenience of zero down against the long-term financial burden of an increased financed funding fee, especially when planning for subsequent uses of this highly valuable benefit, requiring a strategic approach to entitlement use that minimizes the impact of this often underestimated recurring charge. This leads us directly to the third major trap: the entitlement stacking trap, which is perhaps the most difficult concept for veterans to grasp, yet it holds the most long-term financial power over your future housing decisions, because VA entitlement is not an endless resource. It is a finite guarantee the VA provides to the lender, and when you use the VA loan, you are using up a portion of that entitlement. And while you can absolutely reuse the benefit, the way you use it the first time can severely restrict your options for the second time, especially if you plan to move to a more expensive area. And the complexity arises because the VA offers two types of entitlement: basic and bonus entitlement, and the basic entitlement is standard for everyone. But the bonus entitlement, which is what allows you to buy houses above the initial loan limit without a down payment, is what gets trapped, because if you use your entitlement to purchase a home and then sell that home, the entitlement is usually restored, allowing you to use the full benefit again. But the trap occurs in two specific scenarios. First, if you rent out your original VA-financed home instead of selling it, or second, if you allow a buyer to assume your VA loan, a process we'll detail later. Because in both cases, the entitlement used for the first house remains tied up, locked away, and unavailable for your next purchase, meaning you only have the remaining unused entitlement left, which can severely limit the maximum loan amount you can secure for your new home without being forced to make a substantial down payment, transforming the zero down benefit into a significant out-of-pocket expense. And imagine this scenario. A veteran buys a starter home for $250,000 using their full entitlement, then gets promoted and needs to move to a major metropolitan area where a comparable home costs $750,000. And if they chose to keep the first house as a rental, their entitlement is still tied up in that $250,000 property, meaning they might only have enough remaining entitlement to cover a fraction of the $750,000 new purchase, forcing them to come up with a massive down payment, potentially $100,000 or more, that they might not have readily available, completely defeating the purpose of the VA loan benefit. And this stacking issue is exacerbated by rising home prices because the entitlement is tied to the original loan amount, not the current market value, meaning the purchasing power of your remaining entitlement shrinks relative to the appreciating market, making subsequent moves exponentially harder. And the only way to fully restore your entitlement when you keep the first house is through a process called a one-time restoration, a specific provision that allows a veteran to regain full entitlement once. But this is a complex and often misunderstood process, and once you use that one-time restoration, any subsequent retention of a VA-financed property will permanently tie up that portion of your entitlement until the original loan is completely paid off, creating a permanent restriction on your future borrowing capacity, forcing veterans to make difficult choices between retaining a valuable asset, the rental property, and preserving their future home buying flexibility, a complex equation that demands careful consideration of long-term career trajectory and housing goals. Because failing to understand how entitlement is allocated, tied up, and restored can lead to a shocking realization when it comes time to move up or move across the country, turning the dream of a subsequent zero-down purchase into a mandatory high-dollar down payment nightmare. A financial constraint that fundamentally alters the perceived value and flexibility of the VA benefit for those who plan on multiple moves or retaining properties for investment purposes, demanding proactive consultation with a specialized VA loan officer who can model the long-term impact of partial entitlement usage on future purchasing power in various markets. The fourth area where veterans frequently stumble is the appraisal TID trap, which centers around the VA's extremely strict, non-negotiable property standards known as minimum property requirements, or MPRs, and this trap is a dual threat. It can kill your deal outright, or it can drastically delay your closing, causing significant stress and potentially forcing you to lose your earnest money. Because unlike conventional loans, where an appraisal mainly focuses on value, the VA appraisal is intensely focused on safety, sanitation, and structural soundness, meaning the appraiser is essentially acting as a government inspector, looking for defects that might be easily overlooked or accepted in a conventional sale. And the list of common MPR violations is extensive and specific. Peeling paint in homes built before 1978 due to lead concerns, missing handrails on staircases, inadequate ventilation in crawl spaces, leaky roofs, broken windows, water intrusion, or even homes located too close. To environmental hazards like high-voltage power lines or noisy commercial zones. And if the appraiser flags any of these issues, the loan cannot proceed until the repairs are completed and re-inspected, which introduces massive complexity into the negotiation process, because the seller, often accustomed to selling to conventional buyers who might overlook minor cosmetic issues, is suddenly faced with mandatory, often expensive repairs demanded by the VA. And if the seller refuses to make the repairs, the deal is dead, and this is compounded by the poor Tidewater initiative. A specific procedural step designed to handle low appraisals, which is another time sink that can derail a closing, because if the VA appraiser determines the home is worth less than the agreed-upon purchase price, they invoke Tidewater, giving the lender and the realtor a brief window, typically 48 hours, to submit compelling comparable sales data to justify the original price, but this process is notoriously challenging and often unsuccessful, leading to the veteran either having to cover the difference in cash, the appraisal gap, or walking away from the deal entirely. And the trap is that the veteran often chooses a VA loan because they lack the cash for a down payment, making the appraisal gap an insurmountable obstacle. And furthermore, the VA loan process requires the appraiser to issue a document called the Notice of Value, or NOV, which dictates the maximum loan amount the VA will guarantee. And this NOV is final and binding for a set period, meaning even if the veteran and seller agree to fix the issues, the entire timeline is dictated by the VA's schedule for reinspection and reissuance of the NOV, which can add weeks or even months to the closing timeline, making VA offers less attractive to sellers in hot markets who prefer the speed and flexibility of conventional or cash offers. And this preference creates a competitive disadvantage for the veteran, forcing them to potentially overbid or accept less desirable properties to secure a contract, simply because the VA process is perceived by sellers as slow and overly demanding due to these strict MPRs and the rigid appraisal process, requiring veterans to be highly selective about the age and condition of the properties they target, and demanding that their real estate agent be deeply experienced in navigating the specific nuances of the VA appraisal system, including knowing which repairs are mandatory versus discretionary, and how to effectively utilize the Tidewater process, because misunderstanding the rigidity of the MPRs can lead to repeated disappointment, wasted time, and financial loss on inspection. Fees for properties that were never going to pass the VA's stringent safety and structural muster, thus transforming the appraisal from a simple valuation step into a complex, high-stakes inspection that dictates the feasibility of the entire transaction, often to the detriment of the veteran buyer in competitive housing environments, requiring an upfront understanding of the VA's non-negotiable safety standards and the potential for mandatory seller concessions or deal termination. The fifth critical trap is the investment property trap, a pitfall that ensnares veterans who try to creatively use the VA loan benefit to generate passive income or engage in real estate flipping, because the VA loan is strictly and unequivocally intended for the purchase of a primary residence, meaning the veteran must certify that they intend to occupy the property as their home within a reasonable time frame, usually 60 days of closing, and this occupancy requirement is the core restriction that prevents the VA loan from being used for traditional investment purposes. And the trap arises when veterans attempt to skirt this rule, believing they can buy a house, live in it briefly, and then immediately move out and rent it, or buy a property with the express intent of renovating and flipping it for a quick profit. But doing so violates the terms of the VA guarantee and can lead to severe consequences, including immediate loan callback, where the entire principal balance becomes due, or potential legal action for mortgage fraud, a risk that is simply not worth taking. And while the VA does permit the purchase of multi-unit properties up to a fourplex, the veteran must still certify that they will occupy one of the units as their primary residence, meaning they can be a landlord to 3 other tenants while living on the property, but they cannot buy a fourplex and rent out all 4 units. And this is a common point of confusion, where veterans mistakenly believe that because they are allowed to buy a multi-unit property, they can treat the entire transaction as an investment, forgetting the mandatory owner occupancy clause, and the trap deepens when veterans try to use the VA loan to purchase vacation homes or second homes, because these properties do not qualify under the primary residence requirement, limiting the benefit only to the place where the veteran intends to establish their permanent abode, and the VA and its lenders are increasingly sophisticated in detecting occupancy fraud, often requiring documentation like utility bills, driver's license changes, and other proof of residence after closing. And if a veteran moves out too quickly after closing or fails to establish residency, they risk triggering an audit that could jeopardize their financial standing and future access to the VA benefit. And this restriction forces a crucial decision for veterans looking to build wealth through real estate. Either use the VA loan for a personal residence and build equity tax-free, or use conventional financing for investment properties. But you cannot mix the two under the VA program's strict rules, and attempting to use the zero-down benefit for investment purposes is a high-risk gamble that fundamentally violates the spirit and letter of the benefit, which is designed to provide stable housing for service members, not to fund speculative real estate ventures, requiring absolute transparency and adherence to the primary residence mandate, because the penalties for violating the occupancy requirement are severe and long-lasting, potentially jeopardizing the veteran's financial stability and reputation within the lending community, thus limiting the VA loan's utility strictly to owner-occupied housing and demanding that any investment property aspirations be funded through alternative, conventional means that do not carry the risk of mortgage fraud accusations, necessitating clear intent and verifiable residency documentation post-closing. The 6th significant trap that trips up veterans, especially those nearing retirement or separation, is the debt-to-income (DTI) and income stability trap, which focuses on how the VA evaluates non-traditional debt and the future reliability of the veteran's income, because while the VA is generally more flexible than conventional lenders regarding DTI, often allowing higher ratios if the residual income is strong, the way they assess future income stability is incredibly rigid, particularly for veterans who are transitioning out of the military. And the trap here is that a veteran who is approaching their separation date, or ETS, must provide documentation showing they have a guaranteed, stable income source after they leave the service, and simply having a job offer is often not enough. The VA requires proof of employment, often in the form of a signed, non-contingent employment contract, and the start date must be within 12 months of the loan closing. And if the veteran is retiring, they must provide clear documentation of their pension and any other guaranteed retirement income. And the complexity increases if the veteran plans to rely on non-traditional income sources, such as self-employment, part-time work, or irregular bonuses, because the VA typically requires a 2-year history of stable earnings from these sources to count them toward qualifying. Income, meaning a veteran who starts a new business immediately after leaving the service, will likely be disqualified from using the VA loan until they can demonstrate that 2-year history regardless of how profitable their business currently is. And regarding debt, The trap lies in how specific liabilities are calculated, particularly court-ordered payments like child support and alimony, because these are treated as mandatory fixed debts that reduce the veteran's qualifying income. And unlike conventional loans that might offer some flexibility, the VA treats these obligations strictly, impacting both the DTI and the crucial residual income calculation, making it significantly harder for veterans with high support obligations to qualify for the loan amount they desire. And furthermore, if the veteran is still active duty, the VA scrutinizes deployment income and allowances, ensuring that non-taxable income, like basic allowance for housing, BAH, or cost of living allowances, COLA, is properly grossed up, increased to account for the lack of tax burden, but they also look closely at the likelihood of that income continuing, meaning if a veteran is about to transfer to a location with a lower BAH, the lower amount is often used for qualification, reducing their borrowing power. And the deepest part of this income trap is the mandatory waiting period after bankruptcy, foreclosure, or short sale, because while the VA offers shorter waiting periods than conventional loans, these periods are strictly enforced, and veterans often mistakenly believe that because the VA benefit is an earned entitlement, the waiting periods do not apply, leading to premature applications and frustrating denials, necessitating a meticulous review of all potential income fluctuations, debt, obligations, and historical financial events before applying, ensuring that the veteran's financial profile aligns perfectly with the VA's stringent definition of stable, reliable, and continuing income that can support the mortgage obligation over the long term, preventing last-minute income requirement failures that halt the transaction just before closing, requiring detailed documentation of post-service employment stability, and a clear understanding of how non-traditional income streams and mandatory financial obligations are precisely weighted in the VA's qualification matrices. Finally, the seventh and arguably most dangerous trap that veterans face today, especially in a rising interest rate environment, is the assumption trap. And this pitfall has the potential to permanently tie up your VA entitlement and leave you financially liable for a debt that is no longer yours. And assumption is a process where, when you sell your VA-financed home, the buyer, who does not have to be a veteran, takes over your existing mortgage, including your original interest rate, which is an incredibly attractive proposition for buyers when current rates are high. And the trap lies in the fact that when a buyer assumes your VA loan, your original entitlement used to secure that loan remains tied up with that property until the new buyer fully pays off the mortgage, which could be decades from now, meaning you cannot use that tied-up entitlement for your next home purchase, severely limiting or eliminating your ability to secure a new VA loan until that first loan is satisfied, and the financial danger is even greater. Unless the buyer is a fellow veteran who substitutes their own entitlement for yours, a process called substitution of entitlement, which is rare and complicated, you, the original veteran, remain secondarily liable for the debt, meaning if the new homeowner defaults on the payments, the VA can come after you for the loss, potentially destroying your credit, initiating collection actions against you, and permanently jeopardizing your financial future over a property you no longer own. And this secondary liability is the hidden, terrifying risk of assumption, a risk that conventional loans simply do not carry. Because in a conventional sale, the original borrower is released from the debt upon closing, but with a VA assumption, that liability lingers, creating a sword of Damocles hanging over the veteran's head for the entire remaining term of the loan. And while the VA does offer a process called a release of liability, which is supposed to protect the seller, lenders are often reluctant to grant it, and the process is lengthy and requires the new buyer to meet the VA's full credit and income standards, which many buyers seeking assumption cannot meet, or they would simply secure a new mortgage, and the current high-rate environment has made assumption highly desirable for buyers. putting immense pressure on veteran sellers to accept this risky transaction, often without fully understanding the long-term consequences of tying up their entitlement and retaining secondary financial liability. And if the veteran needs to move quickly and use their VA benefit again, they are suddenly blocked because their entitlement is trapped in the assumed loan, forcing them into conventional financing, which requires a substantial down payment and higher interest rates, completely neutralizing the zero-down benefit they earned through their service, necessitating a firm stance against assumption unless a complete and approved substitution of entitlement is executed, or unless the veteran fully understands and accepts the decades-long risk of financial liability and entitlement lockup, because the short-term gain of a quick sale through assumption is rarely worth the long-term, devastating risk of losing both your entitlement and your financial security due to a default on a property you haven't lived in for years. Transforming a simple home sale into a protracted financial entanglement that can limit future borrowing capacity and expose the veteran to unnecessary debt risk, demanding rigorous legal and financial counsel before agreeing to this seemingly attractive but deeply dangerous sales method. So, where does this leave you, the veteran looking to utilize the benefit you earned? It leaves you in a position of power, armed with knowledge that the typical borrower simply lacks, because the VA loan is not a trap in itself. It is the misunderstanding of its unique complexities that creates the traps, and we have uncovered 7 critical areas that demand your attention. The strict residual income test that goes beyond simple DTI, the rapidly escalating costs of the funding fee for subsequent uses, the crippling limitations imposed by the entitlement stacking trap when you try to retain properties, the deal-killing rigidity of the appraisal and MPR requirements, the illegal and dangerous consequences of the investment property trap, the strict scrutiny applied to income stability and non-traditional debt, and the long-term financial hazard presented by the assumption trap, which risks both your entitlement and your financial liability for decades. And the crucial takeaway here is that you must treat the VA loan not as a simple benefit, but as a sophisticated financial tool with a very specific, detailed operating manual. And you must demand that your loan officer and your real estate agent are specialists, not generalists. People who can meticulously model the long-term impact of every decision, from whether to pay the funding fee up front to whether to allow an assumption, and who can anticipate the unique hurdles posed by residual income and MPRs before they derail your closing because your service earned you this incredible benefit. A pathway to home ownership that few others enjoy, but only through deep awareness of these hidden rules and potential pitfalls can you navigate the system successfully, securing the home you deserve without accidentally trading one form of service for a lifetime of unnecessary financial servitude, ensuring that the VA loan truly serves as a benefit and not as a long-term expensive trap.